infrastructure corridors remains critical. With inflation, currency volatility, and high financing costs still endemic, we'll explore innovative financing, de-risking techniques, and PPP frameworks. In this outlook, our experts will evaluate how to convert the region's demographic and resource advantages into resilient growth and real investment returns. So, Bola, I'm delighted to hand over to you as Country Managing Partner at DLA Piper in Africa, based in Nigeria, to lead us through this debate. So over to you for introduction to welcome Razia and Dami. Thank you.
Thank you very much, Chantel. Good afternoon and a warm welcome to you all. Thanks also to Invest Africa for hosting today's event and for convening this very important conversation on West Africa's outlook. It's good to have you all here with us, and I look forward to moderating this discussion once again. We are joined today by two highly respected voices, Razia Khan and Dami Adeshola. Razia and Dami bring very complementary perspectives on West Africa's economic outlook, as well as investment risk. Before we begin, I'll ask each of you to briefly introduce yourselves for the audience. Razia, may I start with you, please?
Thank you, Bola, and it's my pleasure to be talking to everyone this afternoon. I am Razia Khan. I'm the Head of Research for Africa and the Middle East at Standard Chartered, a long-standing interest in West Africa.
Thank you very much. Dami?
Hello, everyone. Good afternoon, or good morning for some. I'm Dami. I'm an Associate Director at Control Risk, where I lead our intelligence analysis work across West Africa. I have the privilege of working with a fantastic team to deliver projects for clients across due diligence, market assessments, political security and commercial risk assessment, and so on. So I'm grateful to be here and to give you my two cover about what's happening in West Africa this year.
Thank you very much. Now, West Africa has always been part of the global investment landscape. And what's changing now is the tone of the conversation. Investors are asking more practical questions about where our growth is coming from, how durable it is, and how risk is really being managed on the ground. We are seeing continued growth across the region, and we are seeing important reforms in some of the key markets. And we're also seeing a much more selective approach to capital. At the same time, global financial conditions are tighter, geopolitics matters more, and domestic pressures cannot be ignored. So today, our discussion is about moving past the headlines and getting into what this all means in practice for investors over the next 12 to 24 months. And as you're listening, please feel free to start sending in questions via the Q&A function, and include your name and organization if you're comfortable doing so, and we will come back to them during the course of the session. Now, we'll start with the macro picture because that sets the context for everything we're going to talk about. Razia, can you start us off with your high-level read on West Africa macro picture in store for us in 2026 and beyond?
Thank you, Bola. So I'm going to put this in the context of what's happening globally. When Standard Chartered produced its outlook for 2026, we titled it An Uneasy Calm. First of all, our global growth forecasts, 3.2%, unchanged from 2025. This is much the same as the IMF and others who've nudged theirs a little higher at 3.4%. But we need to put into context what has been happening. At the beginning of last year, as we were facing the likelihood of growing trade tension escalations, there were great concerns about how global growth may or may not hold up. Everyone at that point was downgrading their forecasts. What we tended to see was a lot of front running of tariffs. So even ahead of the tariffs eventually taking effect, we had seen many emerging nations and Europe and other regions as well front-loading their exports to the US. And this activity lifted global trade, it lifted global growth. And against this backdrop, we ended up with a year when inflation was relatively well contained, central banks were able to cut interest rates in many emerging economies, anticipating a potential slowdown from the trade tensions. They were preemptive in easing. And these conditions really helped this story in West Africa. Now, when we look at economies like Nigeria, the reform momentum is definitely very homegrown. It has little to do with what had been happening globally. Elections in 2023, the embrace of very significant reforms soon after. 2024 was a year of trying to get those reforms to work, and 2025 a year of stabilization. But we should not forget the importance of what we saw. The embrace of FX liberalization, the willingness by the Central Bank of Nigeria to take interest rates to whatever level was going to stabilize the naira, the eradication of fuel subsidies, Nigeria's domestic refinery success. These were very important reforms. And in our view, rating agencies have lagged a little bit behind in terms of the slow pace of the upgrades, given the nature of what Nigeria has put in place and the likely structural transformation. Ghana, too, another economy that had been through a very difficult period after COVID, high developed market interest rates. It meant access to financing for many African countries became very difficult for a while. Ghana opted for a debt restructuring. And when we look back at recent successes and the stellar growth that we saw in Ghana in 2025, the question that tends to be asked is, are there any lasting consequences to a debt restructuring? Now, Ghana was very lucky because in the context of what happened last year, the dollar was weakening, gold was better bid, gold continues to rally, and was one of the key gold-producing economies in Africa. Ghana was obviously a key beneficiary. The question for 2026 is, what underpins the comfort that we're not going to be seeing much change in terms of global growth? We know that global economic uncertainty, almost any index of economic uncertainty, is still at very elevated levels. And history teaches us that when that's the case, we need to be cautious about the growth outlook. But something very special has been happening in Africa, and in West Africa particularly. Normally, when we see a global growth slowdown, there's an expectation that African countries, because of their commodity dependence, might see a slowdown as well. And certainly when you look at oil prices and how bearish the oil market has been on global growth prospects, there might be reasons to be concerned. But what we've seen in the face of all of this is a really strong domestic reform momentum, which no doubt we'll be unpacking further in the discussion today. So our outlook for Africa continues to be good. We see 4.3% growth on average for all of Africa, rising to 4.6% potentially in 2027. And what's underscoring this is really the belief that this good reform-driven growth momentum in the region remains in place.
Thank you very much. And with that broad framing in place, let's bring in the investor lens. So, Dami, from an investor risk perspective, how are you assessing this region's growth narrative at the moment?
Overall, I'll say the growth story in West Africa is cautiously positive. We're not expecting miracles, but we should see small improvements like Razia has sort of giving the numbers, the high level numbers. And in a few markets, we'll probably see the growth numbers moving back towards pre-COVID levels. But the big thing is Africa, West Africa is not just one market. The growth picture is really different from country to country. And this is not new in 2026, or this is not peculiar to 2026. That's how it's always been with countries like Ivory Coast giving, 8, 9%, and some other countries doing much less. So some countries will do better, some will stay stagnant, and some will actually deteriorate. But a lot of the growth that we are seeing will continue to be driven by the private sector, which has honestly been very resilient. And I think we'll talk about that a little bit more in this session. We're starting to see some of the reforms actually show up in the data. Slowly, it's happening, slowly but surely. And I'll also add that in some places, the improvement will look better on paper than they are on ground. So it's very important as an investor to really try to separate what's real, what is just noise and propaganda, to what is a short-term bump, to what is superficial improvement. From the investor risk angle, the biggest story is that growth is improving faster than the risk is declining. So yes, the growth trajectory matters, but because we're looking at how that translates into returns, we also have to look at the risk trajectory, and that really shows us that it's not been really improving and it still remains quite elevated. So we see different patterns across different markets. So in parts of the Sahel, political instability is still a big factor with a lot of coups or threats of coups and juntas still in place. So that's still a big thing that will continue to persist in 2026. We also have issues of fiscal sovereign pressures. Ghana is the obvious example about this, and I believe that we'll talk about that later on in this session, and something to watch for with different countries, really having the big question mark, especially around debt and debt restructuring, but the conversation about sovereignty continues to remain a big factor. Regulatory risk remains real, especially in a country like Nigeria, but it's less about the sudden, policy U-turns that we used to see once upon a time, but more about the complexity and the uneven implementation. There's a whole conversation now about tax and what that really looks like and sort of the gaps that are there. And that's really what the conversation would be around policy and just clarity and transparency. When it comes to security risk, it remains material.